Hey Jared, what's going on?
How we doing, Thomas?
Good, good. My name is Thomas Mineart. I'm an agent with EXIT Realty North Star. Jared, I'll let you introduce yourself.
Yep, Jared Nicolaisen with Key Mortgage Group out in Urbandale.
We're back here to talk to you about real estate. Not anything super local to say today. We don't even really have a specific news article to talk to you about today, but interest rates have been continuing to rise. I believe I'm probably going to mess up the six. I believe percentage wise, they've risen faster than they ever really have. I might be messing up that statistic, but what's par at, Jared, right now? Like just right around.
I think the national interest rate is around 5.5% on a
Yeah.
30-year nationally.
Yeah. So with them starting to get higher again, and I say that specifically to say, if you look at it grand scheme of things, which we'll actually pull up at the end of this video, if you look at it grand scheme of things, we still have pretty low interest rates that are very, very fair to purchase a home at, I believe. If you look at it going back 10, 12 years or so like that, the rates are low compared to that. But last year, um, you were talking low threes, maybe even high twos. So it feels like a big jump, and it feels like it's way way higher when you look at it compared to that. Is that fair?
Yeah, absolutely. I mean, from a consumer standpoint, we were spoiled in terms of interest rates in 2020, 2021. But from a macroeconomic standpoint, we had COVID, we had a slowed economy. So, really, yeah, it's great from a consumer standpoint, but it's only because of a massive, massive issues in the world.
Right. So with that, with them rising, it's finally time to maybe start exploring more options when you're getting a conventional loan. And with that, you're talking about finally a term that I shouldn't say finally, but you're finally talking about arms compared to fixed and actually having the conversation again. When
Yeah.
the interest rates were so, so low in 21, 20, and 19, it was easy just to go with the fixed rate because if interest rates are low, it's a pretty easy decision. But now we need to finally start talking about arms. So just like big overhead view, Jared, do you want to kind of explain the differences and then what people, when applying for loans, will typically see as far as ARM options?
Yes. So, what an ARM is that you're referring to is an adjustable rate mortgage. So, a fixed rate would just be, the most common one is a 30-year fixed rate. It could be 10 years, it could be 15, it could be 20, 25, whatever. But the 30 years is the most common, and that interest rate stays fixed for the whole loan, that whole 30 years. An adjustable rate or an ARM, as Thomas is referring to, is essentially what happens is it's either a 5-year, 7-year, or a 10-year term. And so the rate is fixed for that amount of time. And then after that term, the rate would adjust to whatever the market rate is. There are caps on how much it can adjust, how often it will adjust. So the benefit is depending on your goals. Let's just say that you're only going to live in a house for 3 years. An ARM would make sense because generally the interest rates are lower on those. They are deemed more risky, so there are additional overlays like maybe some higher credit standards, or minimum down requirements instead of that. You wouldn't really do that for a 3% down. It would have to be like a 5% down loan. But other than that, the rates are lower. So in the short term, it could save you a lot of money.
So talk about the caps and adjustment. So what does that normally look like? Is there's a certain cap of how much the interest rate can adjust yearly, quarterly, or what are the
Yep.
people looking at after, say if they were going to go with that 5-1, what are they typically looking at after the first 5 years?
Yep. So if it was like a 5-1, that one would be how often it adjusts. So one would be like a 1 year, every 1 year it adjusts. Another common one is like a 10-6 where it's like, or if I'm sorry, like a 5-6 where it's every 6 months. So that is pretty frequent, and that is a specific product that's like you gotta make sure that you understand it because even though it may not be higher in the future, if it is higher, you don't want to get stuck with, something that's way high, because there is an up cap. So, for example, a lot of them may have like a cap of the total rate, or the total max it can go up is 5% over the life of an arm. So, if you get an arm at 5% and the highest it can go is 5% higher than that, the max rate, if for some reason in the future rates were extremely high, it would be 10%.
And it's a good thing to talk about, though, like, honestly, like, if it was me put in that situation, and I don't know how you talk about it with people, but like, I would be, at least for my curiosity's sake, I would be walking through the worst case scenario. So like, say the interest rates do just keep skyrocketing, and then on that 6th year, it's going to be another percentage point after that. And literally, I'd just be going through the math of what would year 6 look like? What would year 7 look like?
Right.
And that can help kind of put people's ease of mind on it, because I think when you first hear about the concept as a home buyer, you are looking at it and all you see is adjustable, and you kind of take that at face value, and you don't realize that there's caps there, and you start to think worst case scenario about how bad it can really get. But if you really sit there and look at it, it takes a little bit while for the interest rate to build, and depending on what you're looking to do with that home that you're purchasing, there's 2 different exit strategies out of the project.
Right. Yeah, and that's why it's a very goal-oriented product. Like, yes, there will be short-term savings, but Thomas, let's just say that you're going to buy a house and you're going to stay in. This is your forever home. A 5-year arm doesn't really make sense, because unless we're 100% sure that you can refinance before then, if the rates go up, you're kind of stuck with it. Where something like a 10-year arm might make a little bit more sense, because 10 years is a long time. And a lot can happen in 10 years. So the likeliness of the rate being higher than that in 10 years, or within that 10 years, could be pretty low.
Yeah. So you would be more so, what would be your ideal client for a product like an arm, I guess?
An example is someone, her and her boyfriend, they're looking to buy their first home together. And she let me know, like, hey, we're only going to be in this house max 3 years. With career advancements, and we just want something that's our own for the time being. And then we want to get our dream home once our incomes are even higher. We have more cash on hand. We're married, some stuff like that.
Is there a break even point with it that you start talking to people about considering a fixed over an arm? Like, so say for example, it's one of those things that's kind of ambiguous how long they would be in the home,
Yeah.
and they're strong credit score wise, and they have a good down payment. Is that when you start talking to people about a fixed, even if it is their first home?
Yeah, I
Is that
mean,
when you start talking?
if it's close, if it's like, let's just say, and I'm just making up random numbers here, but let's just say they think, it's not going to be short term, but we don't really know how long it's going to be. I would guess maybe 7 to 10 years. We don't really know. My conversation would be like, okay, well, here is option A of a 30-year. The rate is, let's just say, in this case, it's 0.25% higher, and the payment difference is $50 a month. But you have the comfort where that's never going to change.
Mm-hmm.
And if for some reason rates go down, you can refinance that to a lower rate into another 30-year or 25-year or whatever. So that way you have that security. Whereas then I present the arm option and just say, hey, here's another option. It'll save you more in the immediate. If you don't really think that you're going to be in the house for this long, this is a great option.
Yeah, and I'm assuming you could always. Well, I guess how much of a difference, like, say it's like your average credit score, and the down payment would be the same. Typically, how much of a difference interest rate wise are you looking at for arms credit fix?
Um, Depends on the product. I mean, obviously 5 is going to have, you're probably your most likely your lowest rate.
Yep.
That could be, I'm trying to think of the most recent example I have. I would say almost probably 5/8% to almost 0.75% in some examples that
Yeah.
I've seen. And then maybe like 0.5%, maybe 3/8, a quarter to 0.5% on a 7-year, and then like on a 10-year, you're probably looking from like 0.1% to maybe up to 0.3%.
So it could be one of those situations that if you're looking at a 5.1 on that 6th year, you could already have a higher interest rate than what that fixed is.
Right.
So it's a little bit of a risk assessment there too.
Yeah.
And
And so with 5-year arms, we do have to qualify. Let's just say a 5-year arm is 5%. Let's just say we have to qualify on a 5-year arm. We have to qualify using 2% higher, which I think might be the cap on the first adjustment on some of those.
okay.
So if it's 5%, we have to qualify you on a 7% interest rate to make sure that if for some reason you're in the house longer than 5 years, you don't refinance, you don't sell, you're still there, you have to, you're going to be able to afford it.
Okay. Gotcha. So the last thing I kind of wanted to do, I think, and I'm going to share this link in the comment section too, because I think this stuff is kind of interesting. I'm not here to say that I'm some genius economics person, but I thought it would be interesting for people to see and compare it to um, the 82, 83 recession that happened. And that recession was not caused by a mortgage crisis. But with that, there was inflation that caused the interest rates to go up. And I kind of wanted people to look at this and see how quickly they went up and then how quickly they kind of started to go back down again. Just really quickly, I'm going to pull up the shared screen and then we'll
Yeah.
kind of talk through that. And then entire screen here. That pulled up.
Yeah, and I'll kind of just briefly talk about some of that stuff, obviously, with the interest rates. I mean, obviously, they change all the time, and you can see month to month over the years how
Mm-hmm.
the difference changes. So the mortgage that you get right now is
Mm-hmm.
not most likely not going to be the mortgage that you have. You're not going to, I mean, it's rare that somebody holds a mortgage for 30 years.
Is this pulled up now? Can you see it?
I could see it. Yep.
Okay. So 82, I think, is when it was the highest as far as annual average. So we're looking at, or actually, no, 81. So 81, it averaged at 16.63, which was back to what I talked about at the beginning of the video. Interest rates should be so much higher.
Right.
But we're looking at 80 to 81, it going from 13 to 16. And then 82, it went down to average of 16. And then it went all the way down to 13, 13 again, 12. But like it spiked and then went back down fairly quickly. And then, I mean, basically from 83 to where we're at now, I mean, they've just been steadily lowering and lowering with some mild spikes in between them. But like, I just thought that would be interesting for people to see. I don't know. I'm going to stop sharing.
Okay.
That work. Okay. I don't know, obviously, what's going to happen. And we don't know how much more interest rates are going to go up or if they're going to already start to go down again. But I just do think it's really, really interesting to think. I mean, if you look at it in 5 to 10-year blocks, if this is towards the top, if you get yourself into a 10-1 at the most conservative arm, there should be an either chance for you to sell and move into something different and potentially get a fixed rate then or refinance the home that you're currently in. Would you agree with
Right.
that statement?
Yeah, I do wholeheartedly. And I mean, look, when interest rates go down, home values go up. So if you lock in a higher interest rate now, and we have this period for a little while, when they go back down, the home values are going to continue rising again. I mean,
Yeah.
that's just generally what happens when rates go down.
Yeah. And then I think the last point I kind of wanted to talk about was something I was just thinking about too. Like the next time they do go down again, which interest rates are always going to go up and down, believe the realtors when they tell you that this would be a good time to either refinance or purchase a home because it was getting to the point in 2021, I was almost getting so tired of telling people how good the interest rates were because I was starting to feel like people weren't believing me.
Yeah.
But they were truly, it was almost a once in a lifetime type thing. Like,
No, it is. I mean, granted, we lived in the time where affordability was literally it's one of the best it's ever been. And
Mhm.
now it's fallen quite a bit where we've lost 40 to 50 grand of affordability in 6 months, not even.
Mhm.
So
Yeah, and it's kind of that's kind of a shock to the system, but with interest rates rising and you're already starting to see it, prices are gonna plateau a little bit and the affordability should adjust a little bit, but it was just such a quick shock to the system because they're trying to stop some of the inflation that it's just kind of hard to adjust with. But that, I mean, nothing is ever staying the same in real estate.
right.
So it's just knowing kind of what's happening and making smart decisions with that.
Yeah. Dude, yeah, you're 100% right. It'll be interesting to see these next 12 to 18 months. We don't really know what's going to happen.
Mhm. Cool. Well, anyone that is watching or watches this video later, don't be afraid to message Jared and I with questions. We are more than happy to answer them, help you out with either refinancing or selling, then purchasing a new home or just purchasing your very first home. So thank you for watching, guys. Have a great day.